Welcome to TMS Insights. It's Jeremy Hook and Ben Clark bring you an update at the end of April, which has been a rocky month, Ben, for the market in a year which is clearly going to demonstrate a fair bit of volatility. Let's talk about the big issues. There's interest rates, there's the ongoing war in the Ukraine, and we've had this ongoing sort of federal election issue coming up in Australia as well. What are the things that investors really should be worried about, and what's not something that you should be worried about?
And probably China's another one as well now. It just feels to me, Jeremy, like we're going through a really it's a year of change, and the big change, of course, is driven by the inflation that has been created out of COVID, and that has been fueled by the war and potentially now by the big lockdowns we're seeing across China. And we saw a 5% plus inflation print a couple of days ago, and that is bringing us in line with the rest of the world, where we are seeing much higher inflation. The ongoing debate, it feels like to me, is have bond markets overshot themselves, which have risen very aggressively, pricing in significant numbers of rate increases, and also as the world moves on from COVID and people can start to move around normally again, and hopefully supply chains do start to get back on their feet, does an element of that inflation start to pass through? And because it really is driving a lot of things. There hasn't been a lot of company updates. We've had a lot of quarterlies recently. We're about to get some company updates. There hasn't been a lot of stock-specific news. It's really been more about these big macro themes, and I guess the question is where to from here, and it's really, it's very hard to know.
Well, I mean, the main thing is that rates were ridiculously low, and they've fueled the inflation that's creating the rate rises. So it's exactly the push and pull that you get with excessive monetary stimulus, and the unwind, the wash out when that happens is never neat and easy. That's the thing about markets. So we've been talking about the fact rates would rise. They may rise even here locally next week. The point that you've said, Ben, quite well is that market rates have already moved. Whether you're looking at the 10-year bond or the 90-day bank bill, the market is already in front of that. So whether it's announced officially with the Reserve Bank's official cash rate on Tuesday or not, we're there. And the equities have to deal with that. The cost of funds is higher. So it may well be that a lot of it's already happened in terms of that adjustment as a result.
Feels like it to me. I really struggle to see what the bond market has priced in playing out, particularly locally. I can see overseas that there's a stronger case because they've got a bigger inflation problem, but 12 rate rises in this upcoming cycle feel like a lot to me. And I saw Matt Common, head of CBA, Australia's biggest lender, doing an interview and saying he couldn't reconcile what bond markets were saying was going to happen versus how he felt that would impact on their customers and the pain that would create, which of course is what central banks are trying to cause a bit of to take the sting out of inflation.
That's right. I mean, the reality is that the sad language of last year of waiting too long to raise rates means it could cause those sort of issues. So too much stimulation will do that, and again, that's what caused the rockiness coming out of it. But it'll always come back to an equities position where good quality equities, which are growing, will overcome these macro things. They'll impact in the short term, and so we get back to talking about stocks, and we don't talk about the Ukraine, we don't talk about that. We do understand the importance of interest rates, but the other thing is earnings, and let's talk to earnings. We've had a big earnings season in the US, which has seen some real winners and losers.
So this is, I think, a growing question. Is that I would say, a lot of companies still are yet to report in America, but it feels to me like this earnings season is somewhat more subdued than we've seen over the last couple of years,
which were very good.
Which were blowouts. And in Australia in February we had one of the strongest earnings seasons we've seen in a decade.
Unexpected.
Unexpected. And I guess the question as well is, do the pressures that the markets are seeing, which start to come through in companies' earnings numbers? And I think we are seeing that for some businesses.
The costs are impacting on companies as well as other parts of the economy.
Yeah, and if I look at a couple of the companies that we own in the States, Microsoft, which has probably had the best result we've seen so far in the US, there are businesses that are going to be able to, because just of the nature of their business and the quality of their business, they will be able to take advantage of these times, and they will be able to continue to grow despite the challenges that are out there, which is what Microsoft exhibited. And despite that, and this is a reflection of it, Microsoft's share price has fallen probably about 15% from its recent high. The earnings are actually growing faster than the market was expecting. And so a part of this is to do with what's happened in bond markets. But as you said, earnings will overcome the short-term issues that we're seeing there. And you want to stick with those businesses, I think, and not chase the lower quality companies that could do well out of rising rates. It's having that balance.
That balance.
But, there definitely has been more wild swings, more big beats and big misses, coming through so far.
And that speaks to that period of more movement and volatility in markets. Certainly a lot of the COVID winners have been losers in this season, haven't they? And they've really, whether it's Zoom or Netflix or whatever, they've been really hit. Even Spotify had quite good numbers last night, but was down a bit. So it's a valuation issue as well, which you do see in a rising interest rate environment. Locally, Ben, we come up for some quarterlies, some well-followed companies with global operations that give us quarterly updates, because not every company does that in our local market, unlike the US. So let's talk to ResMed's coming up, and REA Group next week.
Yeah, look, by the time this video goes out, ResMed might actually be out. I think it's out Friday, 7 a.m. And the big thing for them is going to be the supply chain issues that they've been dealing with. Philips reported last week, and they've actually pushed out the time frame of this recall by another year, which is great news for ResMed, but ResMed is trying
to... Not
have
its own problems,
So, there's going to be things in there. REA's got its upcoming quarterly.
It's been rather weak when you would think conditions aren't terrible for the REA Group, so...
Listing volumes have been rising, and the election this year seems pretty benign.
It's not a big polarising influence from the parties here. It's vanilla and cream. It's not very different, the two choices here, which is a good parlay. So we're expecting good things overall from REA Group, but let's talk about the election, because it will get more coverage as we lead into the May election, and it's nevertheless a change and often a time of uncertainty. So how does an investor play it, opportunity or risk?
Well, I think this time round there is so little difference from a policy point of view between, probably the biggest risk is maybe a fully hung parliament.
It's a big chance too.
Because I think it does seem like a lot of independents are doing well in their seats. Having said that, inertia is not a bad thing in terms of markets. They don't like a lot of changes.
No, and in fact, if you look at the period post, the 2007 election here, it was a gridlocked parliament for most of that time. And business got about its thing very well. And markets thrived. So
it's bizarre, because it's probably not great for the country.
It'll feel better on the Saturday night and the Sunday of the election result.
And
we've got a hung parliament, and the negotiations will be fraught. But either party can govern in a minority sense, and the country can move ahead quite well.
So
absolutely. Business will progress.
It will progress.
Seasonally, Ben, May and June come up often as opportunity times for markets. You can get some good buying in those periods sometimes.
Definitely.
And you're also coming up to the end of the financial year with some tax-related planning issues.
And so that's it. The old selling May and go away actually hasn't worked the last 2 years. That second half of the year has been a much stronger part. We certainly saw it last year. This year feels like almost a reverse of last year. So I think you got to be careful with historical patterns, and again, I really feel like now's the time. You always want to be monitoring your portfolio, and we're doing that on a day-to-day basis. There is a lot of movement. It's causing us a lot of I guess work, and debating about things, sticking with the businesses that can grow through this period, understanding why some businesses are weak and why some are strong. Because one thing I just say that I have been saying to clients is, there are a lot of businesses that are doing really well as a result of these bond yield moves. If you've got banks or resources,
retailers,
Challenger just had a great update, recently, which has had a headwind from lower rates. Now it's moving into a tailwind. So it's not like everything has come off. It's that some parts of clients' portfolios, they will have noticed drawdowns, and other parts, you've got to remember, are probably artificially been helped by that. Infrastructure's been very strong. Property's been surprisingly strong, that has probably evened things out for everyone.
And differing performances from the sectors, and probably just lastly, as we come into this time of year, remembering people who have got to do contributions and also to make sure their pension drawdowns are done for the year. We saw in the budget that was rolled out for another year, the 50% cut to the pension drawdowns. So I know, Ben, you're all over that. And,
you don't yours yet?
No, I'm not pensioner yet. That's all we've got time for today. We'll be back in May with another update, and look forward to chatting to you if you have any questions.